good day. Welcome to the latest news update on Canary News. In the conclusion of 2023, U.S. inflation picked up, primarily driven by persistent increases in services costs, while the prolonged decline in goods prices came to a halt. Government data reveals that the Consumer Price Index rose by 3.4% over the year through December, marking the highest increase in 3 months. Monthly figures surpassed forecasts as housing costs continued to rise, along with increased expenses for driving and a resurgence in energy prices, the first since September. These statistics indicate a challenging path for the Federal Reserve in its efforts to control inflation, which could remain elevated if prices of goods like clothing and cars continue to rise. The recent downturn, largely attributed to improving supply chains, is now being scrutinized for its durability by Fed policymakers and Wall Street economists. The surprise in core goods, excluding energy and food, was influenced by rising prices for used cars and apparel, despite year-end promotional activities. Service prices, especially within housing and car insurance costs, maintained strength, reaching the highest annual increase since 1976. Analysts, including Scott Anderson, chief U.S. economist at BMO Capital Markets, express concern that the Fed may be facing challenges in achieving sustainable 2% inflation. Despite these concerns, the figures sum up a year in which inflation generally eased without significantly impacting the labor market, setting the stage for the Fed to potentially lower borrowing costs this year. Economic projections from officials suggest an expectation of 3 rate cuts in 2024, though there's resistance against market expectations for the first reduction as early as March. Shelter prices, constituting about a third of the overall CPI index, rose by 0.5% in December, contributing to over half of the overall advance. The moderation in this category is seen as crucial for bringing core inflation down to the Fed's target. Excluding housing and energy, services prices rose by 0.4% from November, slightly easing from the previous month, according to Bloomberg calculations. While Fed Chair Jerome Powell emphasizes the importance of this metric, computed based on a separate index known as the Personal Consumption Expenditures Price Index, economists are cautious about expecting a strong rise in the core PCE gauge when released later this month. In addition to these economic indicators, other news includes the release of the Producer Price Index and separate figures indicating stable unemployment insurance applications and a decline in the number of people receiving benefits. While U.S. consumers grew more optimistic about the inflation outlook towards the end of the year, President Joe Biden continues to grapple with the political implications of inflation, with voters ranking it alongside broader economic concerns for the upcoming election. Despite progress in easing price pressures, inflation remains a challenge for Biden's presidency. Looking ahead, inflation is anticipated to moderate towards the Fed's 2% target, particularly as housing costs are expected to ease. However, potential disruptors include rising shipping costs due to Red Sea attacks and low water levels in the Panama Canal. In international developments, the price of oil surged as the U.S. and its allies launched airstrikes against Iranian-backed Houthi rebels in Yemen. The global benchmark Brent rose over 3% to above $80 a barrel amid concerns of the airstrikes sparking a broader conflict in the Middle East. Meanwhile, gold edged higher due to increased haven demand following the airstrikes. On a different note, China's consumer prices experienced their longest streak of declines since 2009, raising concerns about deflation. The Consumer Price Index slipped 0.3% in December from a year earlier, in line with economists' expectations for a third consecutive month of declines. Export figures also saw a decline, marking the first annual drop since 2016, posing challenges to China's historically significant growth pillar. Analysts anticipate bold action from China's central bank, including a potential rate cut and increased cash injection into the financial system, to counteract the deflationary trend. That is all the time we have for today. Tune in next week for the latest news update. Remember to like the video and subscribe to our channel.